Welcome to another weekly Friday chat, the last one in July 28th. Can you believe it? July's almost over. We are going to be discussing the Fed and how they raised interest rates again to 5.25 to 5.5, their target rate, which is the highest level in nearly 22 years. Let's go. Yep, I have another pizza shirt on. So my goal is to have a new pizza shirt on for every single weekly Friday chat. So we're, taking some weeks off here and there. I probably need about 48 different pizza shirts. Can I do it? We'll see. Okay, so the Federal Reserve resumed lifting interest rates on Wednesday with a 0.25 percentage point increase that will bring them to a 22-year high. Fed Chief Mr. Powell said it was too soon to tell whether the hike would conclude a series of increases aimed at cooling the economy and bringing down inflation. The central bank would decide whether to keep lifting rates based on how the economy fares in months ahead, with a particular focus on making progress on inflation, he said at his news conference. It was a unanimous decision to raise the benchmark federal funds rate to a range of 5.25 to 5.5%. Now, this follows a brief pause in last month's rate increase, and it marks the 11th rate increase since March of 2022. Now, whether the Fed has finished raising rates isn't particularly important to investors so long as the debate centers on whether one or two more increases of a 0.25 percentage point or 25 basis points might be warranted. Now, if they say they're going to raise rates another 100 basis points, well, that is an issue. What is helping is, inflation has retreated from a 40-year high from last summer, with the consumer price index in June, which we spoke about a couple weeks ago, climbing 3% from a year earlier. That was well below the June 2022 peak of 9.1%. Fed officials have been concerned that underlying price pressures may prove more persistent as a solid labor market allows workers to bargain for higher pay, making it harder to get inflation down further. All right. So what does this really mean? Well, it kind of means Fed is keeping pace or keeping on track with what we thought it was going to be. And hence, you can kind of tell by how the markets react if information is what's expected or what we have expected. So when the Fed made this announcement on Wednesday, the markets finished mixed. Yesterday on Thursday, yields jumped up, bond prices went down, and markets, had a rough day. But today on Friday, as of this recording, is about 12:33 in the afternoon. Markets are doing really well. So all in all, it's kind of what's expected. We will see what the Fed does at their next interest rate, and if they're still on pace to raise rates one or two more times, we can hope that they're done. It's really going to depend on, obviously, the labor market and where the inflation numbers come in. The labor market is still strong, which is why we still had a rate increase this time. And at the next meeting, if labor numbers still coming in strong, we're still going to probably have the same, maybe of another 2 or rate increases of another 25 basis points, getting us in that close to high 5s to low 6 range. Well, that's another weekly Friday chat. Pizza shirt edition. Again, my goal is to have a new pizza shirt for every weekly Friday chat. Let's see if I can do it. Remember, Fridays are for pizza. Enjoy it. See ya.